From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, July 24th, 2026. Around the big table today, I've got Dave Sandstrom, Adam Bailey, and here's Kyle Tetting.
Well, thanks, Jason. A bit of an early recording with many holidays and travels on people's calendars. We try to get ahead where we can. Important, I think, Adam, to point out this week just how significant earnings have been for the market this year. First quarter was such a strong quarter. We are now right into the second quarter, kind of getting into the heart of it at this point. A number of earnings reports this week from some of the big tech names, some of the closely followed industrials, especially defense industrials. What have we learned this year from kind of the earnings piece, and maybe what should we keep an eye on going forward?
Well, in short, earnings have been pretty good. Earnings have been on the rise this year, and you're right, we are in the meat of earnings season right now. For just this week, we had a deluge of earnings reports, 435 U.S. businesses reporting. That's more than just the S&P 500, so think of some of the small caps, the industrials, but lots of businesses reporting. For the most, there have been some earnings surprises on the upside. There has been some surprises on the negative. A lot of that has been contained to some of the financials. But you look at earnings and where they are today as opposed to where we started the year. Go back to January 1st. Earnings were expected to be up, maybe 12, 13% for this full year. Here we are halfway through, and you see a 20, 25% rise in expected earnings. And not just this year, but some of those earnings rises are starting to bleed into next year. A lot of that comes from some of the tech build-out, but it's a bit more broad-based than that. So far this year has been some pretty good earnings reports rolling in.
Dave, I've been encouraged by the fact that despite the stronger than expected growth this year, we haven't seen it as a front-loading of next year's earnings. Instead, we've maybe seen some of that money accelerate through the economy. You've worked in a couple of businesses in your life, and certainly you see that when one business is spending money, the businesses around it tend to benefit a bit from that spending as well. We've seen no shortage of hiring, especially in our area, in some of the trades, a lot of cash flow coming from businesses like Microsoft into the pockets of people. Perhaps that's one of the things that's not only helped the earnings piece, but maybe some of the broader consumer trends as well.
Absolutely, Kyle. You look across the economy right now, the amount of infrastructure spending that's coming from the private sector is really unprecedented. Recent analysis in the Wall Street Journal suggests that in the next 6 years, you're looking at $8 trillion going into the data center build across the country. I mean, that's like spending we've never seen before in this economy. And it's pretty tough to do that, especially at the level that's being done at, the trades in particular. Lots of people that are enjoying unlimited hours, increase in wages. And like you said, that typically translates into spending across the economy. We keep that wheel rolling here in the United States from the consumer's perspective, and that usually translates into pretty strong earnings for the rest of the S&P 500 companies.
And that's what we've seen so far this year and expected towards the end of this year. I mean, candidly, a lot of the earnings growth is still expected towards the second half of this year. So if it doesn't materialize, we're going to have some turbulence. But what has been impressive to me is that the earnings growth that has been kind of accelerated from where we were at the beginning of the year, it has also come at a time when input costs are significantly higher. It's much more expensive to borrow. The 10-year Treasury a year ago was at 4%. Now it's at 4.6%. So it costs more to borrow. On top of that, the cost of energy and oil. When we started the year, is at $50 a barrel. It's like 90 today. I mean, you can do that math. That's like an 80% increase in the cost of energy. And yet, even with higher borrowing costs and higher input costs, businesses are still finding a way to be profitable, and we're seeing it in earnings.
And Adam, one of the things that has kind of caught headlines again this week is tariffs. And we really hadn't thought about it much since earlier in the year, the president's kind of initial bout of of tariffs was ruled unconstitutional. We kind of had this, okay, we're going to put some temporary tariffs in place. They're set to expire this week on Friday, and we're already seeing this administration step back into the fray, putting a 50% tariff on many Canadian goods, Canadian wine, maybe not something most of us would look for.
Hockey sticks
at your raised liquor, but hockey sticks for sure. And I made sure I went out and got my hockey stick for my son for this next season early. But if you haven't done that yet, tryouts are coming up, and so probably good to get ahead of those problems. But it is interesting that for all of the problems we seem to face, the Iran war and the impact on oil prices and energy costs more broadly, and tariffs as well now potentially coming back into the fray, Adam, it doesn't feel like investors are responding all that significantly, at least yet, to some of the concerns that might raise for the future.
Yeah, and there are still some concerns out there, especially if tariffs return to the level that we saw about a year ago or even as we started the year. That would significantly reduce profitability for corporate America. I think a lot of how investors are greeting this is, we'll find a way around it or we'll find a way through it. But if we don't, that could create some more volatility if a prolonged trade war, if you will, could have some more lasting impacts on business profitability and labor.
What I find encouraging, Kyle, and I know our listeners may have heard this once or twice on our show before, but it is all about earnings and interest rates. And in the light of geopolitical unrest, we look at what's going on in the Middle East. You mentioned tariffs. Lots of other things in the news that are producing some pretty negative feelings in the economy. We've seen the consumer confidence polls at record lows. Yet investors seem to still keep their eye on those earnings numbers, which is really what you want to look at, right? You need to sometimes weed out the noise and focus on corporate earnings and interest rates. So it's encouraging to me to see that is really what's happening this year.
Yeah, and one red flag may be the interest rate piece of that conversation. We've got a 30-year Treasury now north of 5.15%, the longest stretch we've seen since 2007 with a 30-year Treasury above 5%. The 10-year certainly north of 4.6 right now becomes a little bit more of a challenge to the stock market. It's never about one or the other, but certainly that rate part of the conversation makes it a little more difficult to just go, well, okay, stocks look attractive because earnings are strong.
Oh, the other flag I'll throw out there is valuations. As much as the market has gone up and earnings have gone up, so too have prices. And the value you get when you buy share of a stock of the S&P 500, we're paying north of 20 times future earnings. And that is expensive. Historically, that is quite expensive. If you look at tech stocks, some of those tech stocks are 20, 30, 40, 70 times future earnings. And in our world, when something is that expensive, it can also be vulnerable to a decline. We haven't had that there, but I'll just remind people that stocks are historically on the expensive side right now.
And I think maybe that reminder points out that you want to keep your safe money safe right now, that if you are looking at fixed income, you're being paid enough to buy high quality junk bonds, the bonds of those businesses that are maybe a little more suspect, a little more susceptible to potential default, are not paying near the spreads that we've seen historically. And so for the money you want to keep safe, it makes sense, I think, to focus on that high quality just simply because the market does not seem to be pricing in the risks of default that would require that investors pay or receive a little more pay for those lower quality bonds. And so I think if we kind of think about what's out there for the market right now, clearly a rate environment in which bond investors are being compensated, I would say appropriately at this point, as long as they're willing to stay high quality, less so to take risk, and plenty of opportunities for stocks ahead, even if we've got to pay up a little bit for it. But with the uncertainty that's out there, you're going to be happy you have some of that safe money. We enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.